All right, this is market update 2024 for December. We're looking right now at the basic materials sector, which, as you can see, was really down in December. And I think we're going to see that across all the sectors, but doing really good comparative to the other sectors in the economy. 60% above their 200-day, 50% above their 50-day. Still sort of a bearish signal. When that 50 gets above the 200, we know that we're doing really good. But either way, the basic material sector is doing well. And typically, that just means that we have some inflation in the economy. Because as prices rise, the price of basic materials also rise because you just can't live without them. All right, consumer cyclicals. I'm sorry, no, consumer defensive. Again, this is a sector that we expect to do well as well. But as you can see, only 14% above their 200-day, however, 50% above their 50-day. And so what this means is, comparatively speaking, comparing relative to last year, this sector isn't doing well at all. But compared to the last 2 months, roughly, sector is doing quite well for itself. And so what that means, again, is that the economy has some inflation in it. And so that's why this sector is doing well. These are things that you have to buy, can't live without them. We're talking about Pampers, we're talking about cigarettes, all those things that are going to get bought no matter how much money people are making. But that we can see that the consumer is not doing so well. And that's the reason why I think a lot of these companies are falling or not doing as well compared to last year. And again, you can see over the past month, this sector has been on average down. All right, consumer cyclicals. And this is something that continues to surprise me every time I do these, because you expect the consumer cyclical sector to be doing worse than consumer defensive. But I have a feeling that maybe there is a company in this particular sector that is outperforming everyone else. And maybe that's why the numbers are where they are. Not sure what's going on. Sometimes there's communications, well, not communications, but sometimes there's talks about possibly you have well-to-do consumers versus the not so well-to-do consumers. And sometimes the well-to-do consumers will be doing really well and still buying a lot of this consumer cyclical stuff, luxury goods, that thing. Whereas the rest of the economy and the consumers aren't doing so well. But their expenditures for these luxury items don't matter as much. So maybe that's what's going on. Not sure. As you can see, they're doing fairly well, but not as well as the basic material sector. So again, kind of surprising to see. Really curious to see what companies are performing well in that sector. All right, this is defensive. This is going to be military. This is going to be no wait. Communicate, Lord have mercy. Okay, communications. Sorry, this is communications. So communications is consumer related. But again, it is pretty much like something that you have to buy. So talking about telephone companies, we're talking about television, we're talking about advertising, things of that nature. And so as you can see, again, not doing as well as they did last year, but doing better compared to the last couple of months. Okay, and now we have consumer defensive. So these are your cigarette companies, these are your grocery stores, these are your Coca-Colas and things of that nature. All right, and again, not doing great, not doing great relative to last year, which is what we expect, but doing really good compared to the past month. And as we can see here, the 50-day is far above its 200 days. So that is very bullish, right? So that means that there's some companies in this sector that we definitely want to get our hands on. And I can tell you, I've been following Coca-Cola, and there's been a lot of talk about Coca-Cola really coming back. As you can see, again, this sector is down just like the rest of them this past month, but doing decent. All right, energy. This one is a weird one, not doing great at all. But you can still see that the 50-day is above the 200-day, almost double. So that's very bullish, looks really good. This energy sector won't be down for long at all. The question becomes, how low can it go? But at some point, it will have a big bounce. So really excited about getting out of our current position and possibly getting into another position that is maybe more risky, but has a lot more potential upside. So again, this sector probably performing the worst out of the rest of the market. But as you can see, this past month has only lost 0.29, which is not a whole lot. All right, the financial sector. This one has been doing really well. I think that there is this thing about interest rates coming down. And so that looks really good for the financial sector. But you do also have this idea of the consumer not doing so well and possibly losing jobs, which hurts the financial sector. But I haven't heard a whole lot about credit being an issue, meaning that people are still paying their credit cards, they're still paying their loans. We haven't really heard anything about foreclosures or anything like that. So I think the financial sector is going to continue to do well until it doesn't, right? But as you can see, compared to the rest of the market, it is not doing good at all. Matter of fact, none of these guys are above their 50 and only 22% above their 200. Yeah, so the financial sector not doing well at all. Matter of fact, this might be the worst performing sector right now in the economy. But as you can see, I mean, 7.5% this past month, and I think that has everything to do with the interest rate cut. So we'll continue to monitor that and see where that goes. All right, the health sector. This one did drop quite a bit. You can see that this had a lot to do with the political campaigning and the talks about drug prices and this sort of thing. 43% above their 200-day, 71% above their 50-day. Again, this is very bullish. This 71% is probably the highest out of all the other sectors. So I would say that right now, health sector is where you want to be. We'll talk about that a little bit when we get to the individual stuff. All right, the industrial sector. This is all going to be big industry. So it's going to be machines, this is going to be tools, and that sort of thing. So 63% above their 200-day, 50% above their 50-day. This sector is interesting to me because it's sort of an in between, right? So it is sort of a basic materials, but not quite, right? Because you can live without these things, right? This is more talking about the companies and what companies are doing versus the consumer. And so, as you can see, the companies are doing fairly well, better than the consumer anyway. And so that's really good to see. All right, real estate. This one has not been great for quite some time. Real estate, a lot of times, has everything to do with the consumer because if the consumer has money and they're able to buy new homes, they're able yeah, I mean, buy new homes, build new homes. The real estate sector is usually doing very well. But this also is about commercial real estate as well. This is new company buildings opening up. You know, these are new hospitals, new malls, and this sort of thing. And I don't think we're seeing a lot of that right now. So 58% above their 200, which is not terrible, but only 8% above their 50. And so that's an issue. And then you see this big drop off here, 7% over the last month. All right, technology. This is another sort of in-between sector, right? Because technology has a lot to do with consumer, but there's also a industrial component as well in what companies are doing. And as you can see, the technology sector is not doing great at all. Only 25% above their 200, 50% above their 13% above their 50-day. And we're in a bearish trend here because that 50-day is below that 200. However, you see that it was positive last month. So, you know, again, this goes hand in hand with everything else we've seen so far. And then we have the utility sector. This is the stalwart of the economy. We're talking about utilities where you have to have from everyone, from consumers to businesses, government, everyone has to have power. And so you're going to have consistent, stable pricing and consistent, stable profits. Matter of fact, the utility companies are regulated in the United States so that they already know what their profit is going to be before they make it. So these companies literally just print money, but it also means that there is a cap to how much money they can make. Utility companies typically cannot just go charging whatever they want to charge and make as much money as they want to make. They can't do that, right? Their profits are capped. And so while it is a good place to be for security, it's not necessarily the best place to go out and find growth. And so when the utility sector is doing really well, it usually means that people are looking for security. They don't think the market is doing very well. And when the utility sector isn't doing so well, it's typically because people are coming out of the utility sector and putting their money elsewhere because they are finding growth elsewhere. And so we see that 83% are above their 200, only 17% above their 50. This lets me know that the market right now is looking for growth elsewhere. But that 83% above their 200 simply means that, again, we're dealing with a real giant in the economy as far as making money. So it's not going to be too bad ever. But 17% above their 50 days says something, I think. All right. So I just want to look again real quick. So if money is coming out of the utility sector, the question becomes, where is it going, right? And I think that what's happening is everyone is putting their money right now in this health sector, which makes a lot of sense because the health sector was really beat up and now it's coming back. Same thing with consumer defensive, which is similar to utilities, but this may also have something to do with politics and war machines, right? We know that they just sent, millions or billions more over to Ukraine, and so these companies are going to benefit from that sort of thing. Yeah, communications. I think that's kind of neither here nor there, but I don't see anything like that stands out that's really horrible. So I think we're okay. All right. So basic materials, take a look here. Trox is the sector leading MVP, but only by a slim margin. SMG Scotts Miracle-Gro is where we are, and they are the sector leading performer at 5%. So happy about where we are there. We'll continue to hold. You see this big number is 22%. I believe this is where we sold our position and then quickly bought more once the price came down. All right, communications. Rogers is the sector leading MVP, and it looks like AT&T for the first time in a long time has been the sector leading performer probably since the beginning of the year. AT&T has really sort of turned their whole thing around. They got rid of the TV and the cable, and so they're a slimmed down company. But because they have been like the go-to communications company in the United States for so long, everyone has AT&T, right? And so they are just printing money, I think, when it comes to those numbers. The other in the States is Verizon. And that's it. Everyone else is basically Canada. And so out of Canada, it looks like TELUS is just barely beating Rogers. So I'm actually happy with where we are there and looking to possibly add some more shares. I did check the last time I did analysis on Rogers. It was fairly valued with some upside potential. And right now where the price is slightly undervalued. So we'll look at possibly adding some more shares there. All right, consumer cyclicals. This one. Okay, yeah, IPG, sector leading MVP. This is where we are. But as you can see, International Paper is a sector leading performer with Hasbro and VFC and HRB sort of right there with them. We're not going anywhere from IPG right now. They were down quite a bit, but they're slowly coming back. We see this International Paper is a big jump. I'm not sure what's going on with International Paper, but it's a company that I followed for a long time, and we actually invested in it some years back. And so we talked about like what's going on there. International Paper sells Amazon boxes primarily, and a lot of paper, right? So typically, if the consumer is doing really well, you'll see these companies doing really well. IPG is advertising, Hasbro is toys, right? And so you have toys going in boxes. Not sure VFC or HRB, but it tells me that even though the consumer is maybe not doing awesome, they're not doing bad at all. And it may have a component too where you talk about the well-to-do, right, which actually has the extra money. So when the economy is doing bad, they're not going to be hurt. They're still going to be ordering stuff from Amazon. They're still going to be buying toys for their kids for Christmas. Advertisers are still going to be spending money on advertising to those well-to-do customers. So that may be what's going on here. All right, consumer defensive. And we see Walgreens is the sector leading MVP, but just doing horribly as far as average returns. And again, this is over a 12-month period. And we can see this large drop here back in October, almost 20%, but it's come back and it's up almost 9% this past month. We are currently in Coca-Cola, which is really near the top as far as performers goes. Kroger's is a number one, Coca-Cola right under there. So we're talking about groceries. We're talking about food in this sector, which makes a lot of sense when you think about the fact that, again, there's a little bit of inflation in the economy. And so Kroger and Coca-Cola are going to raise their prices to match that inflation. And there's not a whole lot of consumers that are going to do about it. They're going to continue buying Coca-Cola products. They're going to continue shopping at Kroger's. All right, let's take a look here. Energy. ENB, Enbridge, is the sector leading MVP. This is where we are, but it's really split amongst these guys. And looking at the performance, I'm really shocked. I mean, just a couple months ago, 6 months ago, this sector was just like had crazy numbers, like 7% returns per month, that kind of thing. And it's come down quite a bit. The sector leading performer, it looks like Williams Brothers, KMI, OKE is right there, and Enbridge is not far off. So the question becomes, number one, do we run away from Enbridge and go into something like a KMI or Williams Brothers or maybe an OKE, or do we just stay with Enbridge? That's going to be our question this month. All right. Financial services, we already kind of talked about this one. Blackstone is a huge stalwart in the financial services sector. You know, all of the mutual funds, all of the advisory services and stuff like that run through Blackstone. Sector leading MVP. These numbers look fantastic. 4.6 on average. Regions is where we are, kind of sharing that MVP with Blackstone at 4%. So I'm going to say also sharing the sector leading performer as well. But all these guys are about there. The one thing I can say that's jumping out at me is that the insurance companies down here, MetLife, AIG, they aren't doing so well. And so a lot of times, what happens is two things, right? Either consumers are spending less on insurance because a lot of times when you're not doing so well economically, the first thing to go is insurance, right? The other thing is interest rates, right? So insurance companies typically bring money in and then they invest that money in very safe investments, so government bonds, right? And so whenever the interest rate gets cut, then the insurance companies aren't making as much money investing in those government bonds, and so maybe that's why people are getting out of these insurance companies and going more into these banks. So going back, looking at the 200-day and 50-day, the finance industry is in a bearish trend. So none of these guys are above their 50-day. That has to change if we're going to get anything good out of this. But as you can see, over the last 12 months, all these guys are performing very well. So, we talked about trying to get out of regions. If we did, the question is, well, who do we turn to? And right now, it looks like regions is probably the place to be, other than maybe BK or Wells Fargo. But we'll see. All right, healthcare. CVS is the sector leading MVP, and the rest of these guys are kind of split. Sector leading performer, however, is Organon. Organon is the split off from Pfizer, I believe, long time ago. Pfizer spun off Organon to handle their generic drug business, so like aspirin and stuff like that, over-the-counter medications, versus the prescriptions that Pfizer does. And they've been doing really well for whatever reason. We can't invest in Organon. They haven't been in business long enough. The only reason why Organon is listed here is because it is an orphan stock for us, and so I have to have it in the program for everything to work properly. But we can't invest in this, even though it is sector. So sector leading performer then has to go to Gilead, which is where we are. We're in Gilead. The problem is we can't buy shares at the moment. So we have to wait for the price to come down. Maybe we look at going into CVS or even Bristol Myers, or I forget the backs, forget the name of this company, but anyway, maybe we look at doing something like that. We'll see. All right, industrials, sector leading MVP, MSM. Don't know anything about those guys, and the rest of the sector is split. Sector leading MVP, however, looks like KFI and TRN. I've seen TRN before the last time I went through these. And so we're currently looking to get shares in Fastenal. Like I say, we bought and then we sold. You can see this big number here, this 10%. But the price is coming down though. The price is coming down. So once it gets down to, like I said, maybe 78, 77, hopefully we can get it done this week. We'll get some more shares of Fastenal. All right, real estate, sector leading MVP, GLPI, and then followed by MPW, which is where we are, long time holding for us. Macerich, again, I think we can actually invest in Macerich. I'll have to double check, but it's here because it's an orphan company for us. So I don't know if it's investable or not, but outside of Macerich, it looks like VTR is sector leading performer. But the rest of these guys are about the same. I mean, we're looking at 2-3%. MPW is the worst performing performer right now, 144, close to, well, we got a couple of these guys, WP Carey, ELS. And so it's not the worst, but it's one of the worst for sure. All right, technology. So we're currently in Cisco. That is the sector leading MVP, closely followed by Hewlett Packard. Sector leading performer, however, is GLW. We were just in this company and the name is escaping me. But anyway, they sell glass, Gorilla Glass for phones, glass for TVs. And you know what's funny? When I was following the company, I listened to a lot of their earnings calls, and the CEO talked about the size of TVs continuing to expand. And that's the reason why Corning Corning is the name of the company. And that's the reason why Corning will continue to do well, is because TV manufacturers will have to continually add more glass to the TVs because consumers want larger and larger TVs. And I remember I recorded a video on this, and I was like, "That just sounds crazy." Like at the time, this was maybe a year or two ago. At the time, I think the largest TV screen was like 60 inches or 72 inches or something like that. And I was like, why is anyone wanting anything larger than that? Like anything larger than that is a movie screen, and you might as well get a projector at that point, you know? But recently I saw in Walmart a TV that was 96 inches. And so I was like, God dog, man, that guy was right, you know? So sector leading performer, I guess phone screens are going to keep getting bigger. TV screens are going to keep getting bigger. They talked about using Gorilla Glass and stuff for cars, right? Those displays inside the cars. They're talking about possibly adding that to windshields at some point. I think Jeep was already adding heads-up displays to windshields. So Corning is really knocking out the park in the technology field. And then Generac coming in after that. I forgot what they do. I think Generac is just generators, and so they just do technology for generators. So anyway, yeah, I mean that's interesting. Like I say, we're in Cisco. I don't think we're going to go anywhere. Doing well in that position, but definitely want to keep an eye out on Corning. All right, utility sector. All right, so sector leading MVP is really split, which means you can probably just get any one of these guys and they'll perform well for you. As far as the sector leading performer, we're looking at D and PEG. But these guys are not far behind. We're currently in EXC, which is the worst performing company in the sector. Not sure what's going on there, honestly. I think it may have something to do with just where they are at regionally. To be honest, I'm not going to do an analysis, not even going to look into it. I'm waiting for the price to come down to buy more shares. I think we'll be okay. Once we do have more shares, if the price continues to drop, then I will do an analysis to figure out what the heck is going on and what we can do from there. But other than that, you can see, the rest of the sector is performing fairly well, all about the same, which is what you expect. All right, let's take a look at our portfolio. Now, we have chose to use the up and standard deviation portfolio. And so I want to see what the program has in that portfolio to see how closely we're following it. And then we'll take a look at the performance of the other portfolios. Every time I do this, I'm just like, why don't you do Control F find? Maybe one day I will. All right, here we go. So this is the portfolio that we're following. All right. And so we have ES as a utility. And so again, we just saw that EXC is where we at and it's not doing awesome. So maybe if we get out of that, we can get into ES. FMC is the basic materials. Let me double check and make sure that I'm right about this. I'm like 90% sure though. Let's see. Oh, see, I'm wrong. So it's alpha up, not up standard deviation. I'm in the wrong portfolio. Okay, alpha up. Here we go. So this is the portfolio we're following. So Williams Brothers and Energy. Basic materials is Hunt maybe. Consumer defensive, GIS, financials, BK, we just looked at that one. Utilities, EXC. This is why we're in EXC. Okay, and then IPG, consumer cyclicals were there. Rogers and communications were there. UDR, Man, Cisco, and X-Ray. So out of all these companies, we have 1, 2, 3, 4 out of 11. So what that means is we're not following this portfolio very closely at all. The other thing to mention here is that whatever sector is at the top of the portfolio, that's the main focus of this particular portfolio. Okay. And just to remind, so alpha are companies that perform well when the market performs well. Okay. And then up is companies that when the volume, which means there's a lot of buying and a lot of selling, these companies tend to go up in price versus down. All right. And so it makes sense that an energy company would be at the top of this portfolio. So most of the money in this portfolio is going towards Williams Brothers. And you can see the purchase price was 32, current price 45, right? And you can kind of look down and see kind of how all these things are performing. EXC, probably the worst performer, I think, 41 to 38. IPG, not good. Rogers, not good. And its current price, I think we need to update that. Cisco, okay. So again, we have what, 1, 2, 3, 4 out of 7. So we gotta get better at getting some more of these companies in our portfolio. All right, let's take a look at all the portfolios here. All right, so first things first, just going from left to right. This is the performance of the portfolios as of July 2023 to current. Okay, so we're talking about a year plus 5 months, basically, and this also includes the dividends. All right, now I want to say right away, because we see dividend is the number one portfolio here. Typically, when the market is not doing well, the dividend portfolio will do well because these companies pay the highest dividend. And so you're going to be making money no matter what the rest of the market is doing. All right. And then we have M-score, standard deviation. Again, this is going to be management score, has a lot to do with how much cash is on the books. And again, it has a lot to do with the economy not doing so well, because companies that hold on to cash instead of spending it to grow are going to do well when the economy is not doing well. And that standard deviation number is literally volatility for the particular stock. So these particular companies, the prices don't move around a whole lot. Okay. And then management score is just a straight up management score and nothing else. So, interestingly, they all have the same performance here. So I want to take a quick look, and we don't see alpha up even in the top 10 for these. So I want to take a quick look at not only the M score, but also the dividend portfolio and just see what's in there. All right, so dividend, MDU for basic materials, Canadian Communication, BCE, Bell, NLY, real estate, XRX, which is not doing good at all for technology, but paying a really high dividend. Walgreens, again, paying a huge dividend, but if you look here, purchase price and current price, not doing well at all. Enbridge is where we are. It's a high dividend, but the thing about Enbridge is that because of the Canadian company, you have to pay foreign taxes. So the dividend is not really as big as it is on paper because you have to pay those foreign taxes. Pfizer, always a large dividend. ES, we've seen that one already. Hasbro, we saw that. USB for financial services. So USB is insurance. And as you see, the purchase price and current price is really good. And then MSM, I think we saw that one as well. The other thing I want to mention here is you can see over here in the dividend column. So 1.00 means that this is the number one, the largest dividend in our basket of stocks. Okay. And then 99 is the second largest, 98 third largest, 97 fourth largest, right? And so BCE has always had a huge dividend. But as you can see, purchase price 45, current price 34, which I believe is worse than where Rogers is right now. I'm curious. So yeah, so you see the performance there, right? So BCE is performing, double worse what Rogers is. Um, but it looks like, yeah, but it's the better performing portfolio, no question about it. This is the total return divided by the total invested. So it returns 946, and there is, where to go? 25. Yeah. 3973 invested. And I want to make sure that they're all about, yeah, 3941. Yeah, 39. Yeah. So all these portfolios have roughly the same amount of money invested um, to keep everything similar. All right, let's take a look now at M score and see what's in that one. There we go. All right, MDU, we've seen that one already. Huge dividend. BCE, huge dividend. NLY, huge dividend. And again, this M score is basically going to be how much cash they have on hand. And the reason why their dividend is so large, or better yet, the reason why their dividend is so large is because they have the cash to pay out that dividend. And so this portfolio, I mean, it's almost exactly the dividend portfolio. Matter of fact, it is the dividend portfolio. That's crazy. Let's take a look here. See, YB. I mean, yeah, I mean, this is literally the dividend portfolio. I can't trying to see if there's anything different about it at all. ES for utilities, ES for utilities. Yeah, I mean, this is exactly the same portfolio, and that's why the performance is the same number. And so I imagine it's going to be the same thing with the M score standard deviation, right? So again, we're talking about a very defensive posture is what is working right now. And so that means that we are probably in for a huge drop in the market, or at least the market is anticipating that. And that's why I'm so happy about our cash position right now, because I think we're in a great position to actually get some shares cheap. Same thing. Yeah, this is the same exact portfolio. And again, makes a whole lot of sense because you're talking about, be safe, because you're talking about companies with a lot of cash on hand, large dividends. The stock price doesn't move around a lot. Okay, low volatility. All right, let's take a look at the rolling 12 months. Okay, and so this is just the last 12 months, and this does not include dividends. So this is just the stock price. Okay, and so you see the up standard deviation is number one. And then Alpha Up is number two. And Alpha Up is the portfolio that we're following. I do want to mention here, though, that one of the big differences between these two portfolios is over here. You see that statistically, the low average per month is -9. Statistically, the high is 8. And so the low is bigger than the high, and we don't want that, right? We want our high to be larger than our low, statistically speaking. That just means that if you were to bet on this portfolio, the chances are that you will come out on the winning end versus this portfolio. If you bet on this one, you're more likely to come out on the losing end. Okay. However, that doesn't mean that it can't perform well. right? It just means that statistically speaking, volatility wise, you're probably going to go up and down a lot more in this portfolio versus this one. And you can see that here as well when you look at the last year and a half, right? There's a huge difference in performance there. So we're really good at where we are in this portfolio, this alpha up. I think there was only one time in 10 years that I had to change our portfolio focus in the middle of the year. But usually, once we pick a portfolio, it works fairly well for the whole year. And then we'll look at everything again and make a decision on moving to a new portfolio in July of 2025. All right, I want to look at the worst performing portfolio because that'll also give us an idea as to what's not working, right? So we see here dividend up and M-score alpha are just not working at all. We're talking about almost 2 years worth of data, including dividend. Um, there's something very wrong with these particular portfolios. And the crazy part is we're seeing two of the same portfolios in the best performer. So we're talking about dividend, but works well. The price goes up with a lot of volume, and then M score means they have a lot of cash, but typically work well when the market is doing good. So that means that the market is not doing great. As simple as that. Let's take a quick look at the let's look at the M score alpha portfolio. So I have a feeling it's going to be similar to the other one. And this will kind of just give us an idea of maybe what companies we stay away from, right? And so look at this. Number one, number one, worst performer in our portfolio is Medical Properties Trust, MPW, followed by our utility, E&B. I'm sorry, our energy company, E&B. They do have the same utility company, though, as the Alpha Up. I believe. Walgreens, huge dividend, but horrible performer. FMC, don't know a lot about that one. They do have communications in here. Again, not a great performer, but a huge dividend. Hasbro, decent, but not awesome. CVS, we've seen that one. Not look at this. Purchase at 69 and buy at 56. USB, this is going to be insurance. We already talked about that. This one actually performed really well. The problem is it's way down on the list for this portfolio. So there's not a lot of money going into it. And then XRX, we've seen that one a couple times, not perform well at all. And then MSM, we've seen that one more than a few times, not performing well at all, 95 to 81. So, like I said, MPW is where we are. And so that makes a lot of sense. But I think it has a lot of upside potential. E&B, seeing that one in here kind of tells me, okay, maybe we do need to get out of E&B and get into something else. All right, now let's take a look at what was the other one? The dividend up. Just really curious to see what's in there. All right. Real estate, again, MPW. And this thing pretty much follows that M score standard deviation, which I figured with the exception of Cisco, which is another company that we're in. So three of these companies are in our portfolio. And so that makes a lot of sense. The only thing is that we've done not terrible with E&B. I mean, we actually made some profit there, and we're doing pretty good with Cisco. So I think for the most part, the fact that MPW is at the top of this list is what's giving us an issue. But I want to go back and again, we're talking about this particular portfolio. Okay, large dividend. The price tends to go up when there's a lot of activity, and then M score means they have a bunch of cash on hand, and the company tends to do well when the market is doing well. So again, I think there's some potential in there for Medical Properties Trust. All right, let's look rolling 12 months. worst performing beta return and return alpha. I think this beta return, and it's not a terrible portfolio. 9.896 was just pretty flush. I mean, it's not a huge difference. Return alpha is doing much better, but not like crazy better than alpha up. Let's go down, see if we can even find alpha up. It's definitely going to be at the bottom here. So yeah, 7, 6. So a percentage and a half difference, which is about So you have to go way down here to find something similar to that in the worst performing portfolios. It is very difficult to find. So anyway, so beta return, these are the companies that perform well when the market isn't doing well, but also have a historically high return. And then return alpha are companies that do well when the market is doing well. And those are not performing good. That gives me a little bit of pause because, for instance, Regions Financial is typically a company that performs well and the market is performing well. So let's take a look at return alpha. Let's see what's in there. All right. So energy, top holding in this portfolio. IPG is where we are. So there, EXC. So there's only two companies in this one that we're holding on to. But again, not terrible positions. Devon Energy is a company that I've looked at before. We're not anywhere near that one for any reason, nor are we with these other companies. BMY is the only one that I even discussed even a little bit. AIG, another insurance company. So yeah, I mean, as far as financials go, you want to stay away from insurance right now. All right, so that's it there. Let's take a quick look at kind of just what the portfolios are doing just here recently, right? We can see the dark green are going to be portfolios that are performing much better, and then the dark red are going to be portfolios performing worse, right? And this is by month, so from October, November to December, right? So what we're looking for is what portfolios are performing way better than what they were before, and we see this return up, right? We see this nice green patch here. I can argue these two, and alpha up is where we are. And so we see that one is doing really well right now. And so that's the reason why we want to try to mirror that portfolio as much as possible. And right now, we're just not doing a great job at that, but we're getting there. And then this up standard deviation, we saw that one, right? We know that historically it's not doing awesome, but it did do pretty good recently. And everyone else is just not great. I mean, this one is okay. This is the M-score div. We saw that before. This one is terrible. Dividend up. We saw that one. So, the colors, I think, really kind of help drive home what's doing well and what's not. And so I'm happy again with where we are with the alpha up portfolio. So no need to make any changes there. Again, looking at just some colors here. I'm not going to spend a lot of time on this, but this is month to month, right? And so again, dark green, good, dark red, bad. And so I like to come in here and just look at the colors and just with my eyes, just kind of glaze over and see what looks good to me, right? So we see a lot of green here. It's the upstandard deviation. A lot of green here. Beta return up. I haven't seen that one on any list or anything. All right, so you see some of these sort of, I don't know, kind of in the middle portfolios. but it doesn't seem like there's a lot to choose out of, honestly. The few that I saw that looked, I mean, this one looks okay. M score div, sort of kind of in the middle of a thing. A lot of yellow in this one. This one looks good. Beta return up. I think this 5 and that 3 is kind of what took it out of contention. And then the other thing that I like to do is just looking at the colors, right? What sectors are the ones that's performing best in the better performing portfolios, right? So these are the portfolios month by month over the last 12 months that have performed the best, okay? And so everything over here on the right are portfolios that have these particular companies at the bottom of their list, which means they don't have a lot of money in these particular companies. And maybe that's why they're performing so well, right? So we see the back half is almost all purple. And so that's going to be communications companies, right? We see a couple times where the purple jumped up into the middle of the portfolio, but there's only once or twice where we see it at the beginning. But most of the portfolios have purple at the back. And then on the other side of things, we see a lot of yellow in the front. Matter of fact, there's no yellow towards the back at all. And so what that means is that our portfolio ought to have a larger percentage of energy companies as part of our portfolio. Right now, the largest position that we have is actually in financials, which is towards the back half of these portfolios over the last 12 months. And then you see black is sort of in the middle. We see this kind of bright blue. This is the basic materials sector. It's towards the front. But yeah, so definitely want to try to mimic what's going on here, but as well as mirror what we see in the other in the portfolio. All right, and then just want to take a look graphically at kind of what the market has been doing, at least our basket of stocks anyway. You see, it's been really flat when you talk about January going forward. There hasn't been much change at all in the 200-day. There's some ups and downs, of course, but for the most part, it's been relatively flat. Same thing in the 200-day. Sorry, this was the 50-day. Sorry, the 200-day again, relatively flat. Hasn't moved around much at all. It's gone up and down, but and right now we're in the downtrend, right? So we know that the 50-day is below the 200-day. So I expect the market to continue to move down. At some point, we will see an uptrend, but I don't know when that's going to happen. It hasn't happened in quite some time. We've been pretty much in a downtrend for the last maybe year and a half. So anyway, that's it. I think we've covered everything. Again, Alpha Up is a portfolio that we're following, and it's still performing fairly well. Again, we only have roughly 4 companies in that particular portfolio. So going to do our very best at getting out of some of the positions that we're in and getting into some winning ones. All right, that's it from me to you. Holla.